Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that are just strange. What's on deck for today? Well, the first up is the markets took off in pre-market trading. So before markets open, the futures market comes. The markets kind of futures markets open during Asian and European markets, but then for the U.S. investors, it opens an early trade before normal trading opens, and stocks were up a whole bunch to lead people to think, well, that's really good. Everyone's bullish. Well, not so quick. It's not quite what you think it is. It has a lot to do with someone came in about a month ago and bought a monstrous amount of VIX call options, and they're going to expire worthless, and I'll show you what that looks like. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, more personal capacity, opinions expressed via that alone, and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So here I'll show you. This is easiest seen in the VXX ETF, which is a midterm exchange traded fund for the VIX Futures. Something you should never trade, never buy, never sell, never short, never long, never anything with this. Here you can see going back to the end of last month, there was a huge amount of volume. A lot of call options were bought in here. Now at the time, no one knew, but trade desks have a quick way of getting information around when people want to know what happened. And so because all these options were bought, dealers were forced to hedge that. And from what I can gather, these options were very short term, and with volatility heading lower, as we can see on the normal VIX index, you can see it headed lower. What that means is these options are likely to expire worthless, and the closer they get to their expiration date, the dealers can unhedge their positions because they don't have the risk. And so as a result, what happens, stocks started, closed the day down here and opened and barely moved all day. In fact, from when we look at trading volume, it was very, very weak. So there's not a lot of interest in people buying stocks today. And part of that reason is a corporate share buyback bonanza is quieting down. Corporations are now getting more focused on their debt, their balance sheet, and the amount of share buybacks is decreasing. And that's why we're not seeing all this big volume and big push in stocks anymore. Now, what didn't make the headline news today, and it probably should have, is the Bureau of Labor Statistics, as I have mentioned in the past, blatantly lies about every payroll report because they create fictitious jobs. Announced this morning that they're going to have their largest downward revision in history. They rephrase it as the March payroll report, but I believe it's the 12 months leading up to the March payroll report. But they tend to just make a 1 month adjustment. And what's going to happen is the number of jobs they thought were created up until March, the year up until March of 2019, they were wrong by over 500,000 jobs. So there were 500,000 jobs that were not created, that were reported, that will get adjusted in the months to come or by next year. Of course, the market didn't care about this too much because it's old news. The market's looking at the day-to-day and saying, oh, well, there's 500,000 fewer jobs. Who cares? And then after all that, we had the anticipation of the Federal Open Market Committee meeting minutes that investors were really hoping the Fed would come out and say, we're super bullish. Super bullish, super bearish, and we're going to lower interest rates. And the Fed did not give any indication of that. They acted as if, everything's okay, and that this was just maybe a 1 or 2 rate cut and done. It's not likely to happen, but the Fed is acting that way. And of course, these minutes were from last month's meeting. So the Fed now will find out that there were 500,000 jobs misstated. And the reality is they're probably going to cut at the end or at the middle of their next month, which is their meeting. Now, Friday, Jerome Powell, who is on vacation at Jackson Hole, Wyoming, where the Fed and other central bankers go for their summer powwow, he will be speaking on Friday. It is not a policy speech, but should shed some light on where the Fed's at. Now let's take a look at the NASI, the NASDAQ McClellan Summation Index, and it's trying to hold where it fell maybe a month ago. It's trying to hold that bottom. It's looking for liquidity, but the markets are drying up. They really need to find some liquidity here. This is not a buying event until it really plunges. We really need to see this thing draw down. Now, from the agricultural commodity sector, what's going on right now, and this is not sanctioned by the USDA, but teams of people, and again, I don't know, where or why, but I'm sure they're part of some organization. They go around to fields in different areas, and they have a path they go through, and they do it every year, and they pull corn and soybean off the vine, I guess you could say, and they count the number of kernels, and they measure the corn and the size, and they do the same thing with soybeans, and then they start to report on it. And what we're hearing so far, and what we can see in the photos, is some of the crop's okay, a lot of it's not. The farmers are concerned about the maturity of the crop and getting it to a production level where it's ready to harvest, because there isn't much time. And what farmers really need right now, because when you have hybrid seeds, you need perfect weather. And farmers really need hot weather right now. Some people said there was too much moisture, too much groundwater. So what they want is hot weather and minimal amount of rain. All right, well, let me show you what they're going to get. So according to NOAA, the 6 to 10 day forecast, you see a big cold front kind of moving into the farming region. And what do you get? More rain that they don't want. They don't need that right now. They need dry heat. And you can see the 8 to 14 day forecast, that cold front is just going to hammer right through the middle of the growing region. And the fear is you can get, frost or things of that nature, or earlier winter, which would really be devastating. And you still have above average rainfall coming through there. Now, they're going to get some drier conditions potentially in the weeks that come. But what they really need is this hot zone to move over here. It'd be interesting to see if it actually does all of that. All right, let's hit some charts and see what else is going on in the markets. Get some of these windows out of the way. All right, on to the S&P 500. As I said, it gapped higher and really just did not move today at all. There was just no excitement in the market, so maybe it will go higher. From a volatility perspective, this is one of the reasons that I like to look at volatility. Is it unreasonable that I think as these options, continue to expire and the dealers remove their hedge, could we see volatility come back down into here? It would not shock me. Now, if it happened, what we should see is stocks make a push towards their new all-time high. But today, looking at the VIX index, you could see a pretty sizable drop in volatility, virtually no move in stock prices. So it is possible we could see volatility continue to drop. Let's go back to the VIX to see it fall. It may not get a big push in price, which would be a red flag. You want to see these things move together. And when they don't, well, then that's not good. So let me fix that there. All right, let's take a look at Treasury yields. So 10-year Treasury yields moved a little bit higher after the FOMC minutes. Initially, they moved lower. In fact, you can see they kind of went down, and then eventually they moved back higher. Again, the market is big on pushing interest rates higher. They need liquidity. What you get liquidity is, or one of the ways is you can drive interest rates up. We saw the 30-year also move higher. Looking at TLT position in the portfolios, as I've expected, this thing should drift a little bit lower, somewhere in this range here. There's a lot of support. You look at the volume here, you can see this is buying volume up into here, and then you get selling volume. So the support is right in somewhere around this dotted purple line, and you have the 50-day moving average rising, which has been a great area of support. So what does it tell me? That interest rates could rise, bond prices could fall into the zone, catch the 50-day moving average and take off. Wouldn't surprise me, but this is somewhere in here is where I'd like to do that full rebalance of the portfolio and pick up the zero coupons and ditch the short-term bonds. That's kind of the plan. So hopefully it'll play out where we can do that. Crude oil is sitting right in the middle of this ascending triangle and just under its 200-day moving average, this kind of squirrely tan line. This is, again, a bearish pattern. It tried to get down here, found support, but again, crude oil is likely to head lower mainly due to its relationship with 5-year Treasury yields, which we can look and see. Where's 5-year Treasuries? Are low. So if we overlay, let's say if we a little, whoops, let's see /CL. Let's see if this will work. Yeah, so you can see these two are on a 1-year chart. You can see they do move together. So what 5-year yields are saying is crude oil prices need to fall. All right, let's continue on. Some things of interest. Gold futures looking like a topping pattern. Again, the speculative position in this is now at a record all-time long. This will unwind. There really isn't a catalyst at this point for this to drive higher. Again, what I expect to see is bond prices take off, gold to come back down, sell the bonds, buy the gold. That's kind of how it played out in 2008. I think we'll see something similar to that. Mining stocks are obviously leading the way back down. Here's the junior miners. Here's the silver miners looking like they're still in topping pattern, trying to find a way to make this 50-day moving average work for them. And then the big gold miners are still just hanging out up here. The market's really bullish on this, but the positioning is actually bearish. Let's take a look at ag commodities. Trying to make a bottom on low volume, which would be a positive sign for ags, because this would tell you that the sellers have dropped the price as low as they think they're going to get it. And at that point, once the sellers are exhausted, you'll see buyers step in and then perhaps unwind a lot of the short interest that's sitting here. All eyes really should be on Apple stock. Let's zoom out on Apple. And this band here is a sell zone. And you can see it's sold here, sold above it, sold here, and sold here. So if this gets above this zone, which is somewhere around 215 a share, that would be bullish for stocks. If it can't get through here, it's bearish for stocks. This pattern overall is actually rather bearish, so it's not a bullish outlook. Let's see what else we've got to take a look at that may be of interest. We haven't looked at bank stocks, and I've been meaning to. I keep forgetting to. This is a big topping pattern. Let me zoom out. This is more of your regional banks, and you can see it's got a big shelf here that is sitting on top of. This is a 2-year pattern. So if we go to the 2-year chart, you can see we're right back at the beginning there. Should this break down, and it will, that tells you an early warning sign that interest rates are about to collapse. So it's got a shelf to here, which would take it back to where bank stocks were at the election. And then if it can't hold there, then you've got bigger problems to come and more downward prices. But interest rates they are telling us that this is a topping pattern. This will break. The only question now is when. What I can tell you is the middle of next month, in addition to the Fed speaking, and somewhere next is, I don't know, have the exact date, where the Treasury is going to begin its big borrowing binge. The corporate share buybacks are at about a 75% blackout across the board, right smack in the middle of September. So you got to keep in mind, the corporate share buybacks have been keeping stocks up, and they're running out of ammunition. So they're not able to keep pushing it. They're running out. Well, now we've got very weak liquidity, not a lot of liquidity in the market. You've got reduced corporate share buybacks, a blackout period coming, the Treasury going to borrow, Fed likely to cut. So September is going to be interesting. Again, why I really want to get the portfolios rebalanced prior to that, but I'd like to do it at an attractive price. So if we can get it done this month, great. If it's early in the next month, I'm not one normally to front run Fed meetings, but I'm pretty sure they're going to cut. I mean, everyone else is cutting. They're going to be forced into it. And we still have more payroll data to come and some other information that certainly could change their view. So I think with that, we'll just, let's look at one last chart. Let's go and look at oil and gas producing stocks. If we've looked at, they broke down this long shelf that goes all the way back to 2016. So if we zoom across here, you get a little bit better picture of that. And it broke down here, which usually is very bearish, and since it's never been this low, indicates that it could go further, and it won't bottom until you get kind of a cascading fall and a big slug of volume. That's what you're looking for. So what's happening now is what was support, price support, is now becoming resistance, And we're seeing prices try to come up here and get back into resistance to flip it back to a level of support and not having much luck. So at some point, these stocks head lower. There's a lot of risk in these smaller oil companies. They've got a lot of debt. And I think there's about 18 companies already in the Permian area or somewhere in Texas already filing bankruptcy. So not really a good sign for the economy. I'm Steve Van Metre. Hope you enjoyed tonight's update. I'll see you Friday for our weekly economic update. Bye now.